right now. Our featured guest today recently wrote an article in the Wall Street Journal raising concerns about a handful of stocks. John Rogers, the co-CEO and CIO of Ariel Investments, he joins us now. It's good to see you again. It's been a while. Hope you're well.
Yeah, great to be back.
So, I don't know how much of the prior conversation you heard, but when you look at the market right now, what do you see?
Well, I think it really is a tale of two markets. I think in the small and mid-cap value space, there's still an enormous amount of bargains. A lot of companies selling for 30-40% discounts to what we think those businesses are worth. But then the S&P is dominated by the FANG stocks, and they, I think, are extraordinarily expensive. The optimism is just amazing. Everybody's pouring more and more money into indexing. And so for us, we feel like this feels like the 70s when you had the Nifty 50. And of course, that ended badly for those growth stocks and helped out the value stocks. So that's where we are. We say buy value, buy smaller companies. That's where the opportunities are. And avoid those large cap growth names that have gotten to be so expensive.
So that leads me back to what Tiffany just said, John. And that is that you have to throw out, these are her words, throw out the old rule book on valuation. So maybe how a John Rogers looks at something today and sees how it's perceived to be so expensive, maybe in the old way of looking at it, sure. But maybe now, given some of the changes in society and the way things are traded within this market, they're not so expensive after all.
Well, as you know, a lot of us old school value investors who have really benefited from Warren Buffett's wisdom, when any time someone says this time it's different, it's always a warning flag for us and for me. And so as much as I love my friend Tiffany, I think I have a different perspective on this. I would think it's a sign of caution when people are talking that way.